Hi everyone, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll check out how markets are trading currently. We'll look at the current political scenes in Japan and briefly touch upon that, as well as then looking at equities as we normally do. So we'll look at US major stock market indices, the charts, and also, of course, earnings season, and have a look at briefly some key points around Tesla's earnings, of course, which are due out after the US close on Wednesday. After that, we'll get into last week's main events, which were um, uh, just a couple of data points around Australian labour market data and also UK employment data. And then we'll get into this week's main events. A lot of inflation CPI data out from various different countries. So we'll look at that out of the US CPI data that is due on Friday. So a delay to that data, of course, but very important for markets and probably the only main data that we'll get ahead of the Fed meeting next week. Otherwise, we also will look at UK CPI data, Japanese CPI data, and also, if we have time, Canadian CPI data, and we'll look at all the major currencies affected with those data points. So the DXY, cable, sterling against the dollar, dollar CAD, and dollar yen as well. We do have PMI data as well, actually, I should mention on Friday. So we'll briefly look at that. And we've got a matrix from Reuters just showing you the sort of red and blue figures due potentially, red being below 50, contraction, blue being above 50, so expansion. So we'll look at that shortly. If you can bear with me 1 second, because I've just got a technical issue that I need to address. So if you can just bear with me 1 second. But this is what we hope to get to in the next 30 minutes. Just if you can, just bear with me 1 second. Okay, my apologies about that. Yeah, we should all be good to go. So here we are. Is the disclaimer that you can see, and then obviously what we hope to get through in the next 30 minutes, as I said. So first up, just checking how markets are trading currently. Well, APAC stocks were higher amid tailwinds from the recent trade-related rhetoric after President Trump commented on Friday, actually more positive he was that 100% tariffs are not sustainable and that he will be meeting with Chinese President Xi very soon, in a few weeks, I think. The Nikkei, that surged to a fresh all-time high above 49,000 now amid basically a reignition of the Takaichi trade. We'll talk about that shortly. We also had Chinese data, that big data dump that we get with GDP, industrial production and retail sales, either matching or topping forecasts. We do get the CPC Central Committee also holding a 4-day closed door meeting plenum through to Thursday, so that'll be important with the 5-year plan. So watch out for some headlines on that. As I said, President Trump on Friday, he said the US is getting along with China, and it looks like a meeting with China will go ahead. And while he could move the November 1st deadline up if he wanted, he probably won't be doing that, is my thoughts on it anyway. He then added that they will make a deal that will be good for both countries and thinks they will be in a strong position in trade talks with China. So TACO playing out here, really, which is what we talked about in the last couple of week ahead commentaries as well. The acronym Trump always chickens out, essentially having announced about the 100% tariffs. That really isn't something that both countries would want, and especially the US, where I think average tariff rates would then go up above 30%, which isn't sustainable. And we wrote about that in our weekly commentary, as I say. The S&P did lower actually France's credit rating to A plus from AA minus. Outlook stable. It cited heightened risks, of course, due to budgetary consolidation. But European stocks pretty positive this morning. Today, Euro stocks up around 0.8%. After the cash market finished with losses of 0.8% actually on Friday. Asian markets, as I said, they started strongly with really good performance in the Nikkei. The Nikkei, sorry, up 2.9%. Just touching upon that, really, the LDP party, they reached a coalition agreement with the Japanese Innovation Party, Ishin, building the case for a growth supportive policy. Things have been or had been pretty unpredictable, really, most unpredictable they've been really in many years, due to obviously post Takaichi being or winning the LVP election vote, then struggling to gain a coalition or group together a coalition. And there have been, of course, different opinions on the correct extent, really, of fiscal as well as monetary stimulus. A parliamentary vote for the Prime Minister now is scheduled for tomorrow, and Takaichi should now have enough votes to secure another LDP-led government. Ishin, for your guide, they want social security reform, lower VAT, and a smaller parliament. LDP staying in power really means that the largest opposition party, anyway, that's the Constitutional Democratic Party, which had previously advocated for the Bank of Japan to lower its inflation target and hike interest rates faster, that will not gain influence. And we haven't seen a massive move in dollar yen, actually. So interesting, really. No clear trend there, although it is weakening. And Japanese yields have been rising a touch. Yeah, that's in Japan. China, I mentioned that data, the monthly data showed GDP, third quarter GDP slowing to 4.8. So in line with consensus, actually expectations of 4.8 from 5.2 in the second quarter. Industrial output growth, that was the main surprise, actually at 6.5%, well above the consensus of 5% from 5.2 in August. That said, the domestic economy kind of remains weak. House prices are down by 2.2%. Private consumption continues to struggle. So yes, sort of mixed data out of China, really. Otherwise, if we look at then the first chart that I've got in here, that's on earnings. Actually, before we get to that, I'll just move to this chart first up. And before I get to that, generally equities rebounded on Friday after a volatile week, very choppy week. We used that word quite a few times just to describe price action, really, both positive and then negative, and pretty choppy, as I said, dominated by earnings and then renewed concerns around late on Friday around potential credit losses in the US banking sector. Financials certainly at the center of attention, really. Insurance was the weakest performing industry last week, while banks really did better, backed by solid results from the big US banks, that is, of course. Those earnings kind of helped stabilize sentiment, provided some support to the sector overall, even as we do get worries lingering really around smaller regional lenders, and that's what we saw late on, late last week, really. And this chart, sorry, worries around, small regional lenders, really, and it sort of highlights this K-shaped kind of recovery in which basically some banks do well, the big banks really, and others really, the smaller, much smaller regional banks don't do so well. This keeps rates under control and really sort of eggs on the stock market, if you like, but potentially increases these differences that you get between Wall Street, big investment banks doing well, but then on the chart, you can see the black line, the regional banks in the US not doing so well. So it's this idea really of Wall Street versus Main Street. Wall Street doing well, of course, Main Street really not doing as well. And of course, there was this quote from Jamie Dimon last week about cockroaches and whether we get where you get cockroaches, referring to regional bank issues, credit issues, then you generally see more of those going forward. Um, yeah, it all contrasts then, as I said, with investment bank results being decent, and then regional banks really hit by credit worries, and then those cracks potentially are in those Main Street lenders. And as I say, Jamie Dimon mentioned about auto loan credit issues, being like cockroaches, and when you see one, there are probably more. So just something to watch out for going forward. Otherwise, on Friday, as I said, stock market steady, really. Dow up 0.5%, the SP up 0.5% as well, Nasdaq 2, while the Russell 2000, the index of small caps, that dropped into negative territory on Friday. Okay, otherwise, earnings wise, we had this chart which is actually at the beginning of earnings season, so that will have changed slightly. We this week have 86 of the S&P 500 listed firms releasing earnings. Really, as now the Q3 earnings season broadens out. Of course, we have Tesla's earnings out on Wednesday after the US close. That could shape sort of sentiment across EV and also AI links names. We also get Netflix results out after the US close tomorrow, Tuesday, that is. They should probably reveal the impact of recent price hikes. And then on Thursday, we get Intel's report, key really for semiconductor momentum, of course, and especially after TSMC's upbeat guidance last week. We also have GM, GE, and Ford also this week, all to look out for as well. That's sort of general earnings. If we just pull up a Tesla chart now, actually, so bear with me 1 second, and I'll find that very quickly. Which is here. Let me just pull it back because I've got some fib levels in here. Take off the Keltner channels for you. So it's easier to look at, really. Interesting consolidation around this fib level, 430 or so, just around that, just below that previous swing high from early October at 470, and then the all-time high at 488 from back in December of last year. Tesla really, well, it's still sort of languishing really slightly now, up around 8%, I think, higher on the year now. Though certainly better than expected. Q3 delivery figures have provided a boost in recent weeks, certainly. just for your guide, it stands around the eighth biggest stock in both the S&P 500 and the Nasdaq 100. That's why a lot of attention, of course, is paid to it. Of course, as well as being part of the Mag 7. Consensus expects adjusted EPS at around 50 cents, and that's on revenues of around 25.3 billion. Five things to watch really for us then will be, and most analysts will be watching for gross margins, excluding regulatory credits, of course. Are cost improvements now showing up yet? Secondly, order trends. Certainly, they will be looked at after the US credit expiry, and early signs from October then will shape Q4 expectations. Moving on from sort of EV stuff, energy storage profitability, that will be key going forward, really. And questions around can this segment offset any sort of EV automotive compression. Also then FSD, full self-driving, and then robo-taxi metrics, they will be looked at. Sort of any measurable data really could shift sentiment dramatically rather than sort of very broad general figures that, of course, Elon Musk has sort of announced in previous reports. And then finally, guidance and cash flow, really. A steady CapEx and R&D plan could show discipline amid, of course, big ambitions that Tesla does have. For your guide, options on Tesla are pricing in just above a 7% plus or minus move in the 24 hours following the release. So that's up or down 7%. As I say, just for your guide, we're consolidating around this minor fib level, around 430 or so. That's swing high from early October at 470, all-time high at 488. If we do lose probably this initial support around 411, then you've got the 50-day moving average, the black line at 387, and then a major fib level, if you like, of this move lower, the 61.8 retrace level, that's at 383 there. And then below that, 351 is the halfway point pretty much of this move lower. So that's Tesla, just for your guide. And some info on what main points to look out for after the close on Wednesday with their release of their results. Otherwise, actually, let's just quickly look at, let's quickly grab a couple of the stock indices charts just very quickly. We're just hovering below all-time highs, really. This is the Dow. You've got the 50-day moving average at 47,725, being decent support, actually. So just watch out for that level. Otherwise, all-time high just above 47,000. The Nasdaq just below that all-time high, of course. At where are we? At 25,195. Then the blue line and also that upward trend line. The blue line is the 50-day moving average. That's just above 24,000 at 24,133. And then just on the S&P 500, again, similar charts. We've got some fib levels in here from that low in May of this year. Again, sort of tallies with the 50-day moving average at 65.64. First minor fib level at 65.29, and then the all-time high is 67.64. Okay, moving on from that to last week's main events, mainly just a bit of UK data and Aussie jobs numbers as well. The UK labour market data, that came in on the weak side of expectations, really, particularly the unemployment rate edged higher to 4.8%. Private sector wage growth declined to 4.4 from 4.7%. Same time, well, the data was not all dire, actually, because job losses actually showed a modest 10,000 increase in September, but there was a revision for less steep payroll decline over recent months, actually, as well. In sum, then, data sort of points to the weak side, keeping the chances of a November rate cut, marginally alive. Even if one of the following meetings is starting to look more likely, probably in the new year. Governor Bailey, Bank of England Governor Bailey, he did express some concern about job markets in public appearances last week. So that was that data. We'll get on to cable and the odds of Bank of England rate cuts when we look at the CPI data shortly. Otherwise, Aussie jobs, if I just pull up the Aussie chart, actually, bear with me 1 second. Aussie jobs then, that came out for the month of September, somewhat mixed data really. The economy added just under 15,000 jobs, 20,000 jobs expected. Largest share being in full-time occupation. Part-time jobs increased by 6,300. But then the unemployment rate, that unexpectedly jumped from 4.3 to 4.5%. That was the highest level since November 2021. Though there was an unexpected increase in the participation rate actually to 67% from 66.9. That offers at least part of an explanation for that jump in the unemployment rate. If anything, the Aussie actually marginally weakened after that data, despite an overall soft dollar. And then looking at the Aussie dollar chart overall, you can see we're just hovering below then the 50-day moving average at 65.50 and below that fib level at 65.49. So that could be some decent resistance. Yeah, just sort of consolidation. Potentially, if we do lose, then the next sort of retracement level, 64.27, is a halfway point of this move lower, which is just below those lows from last week. Then yeah, we've got decent support around that level actually. 64.27, probably pretty strong support. Otherwise, the next fib level is somewhat below that, 63.06. Otherwise, just topside. Sorry, if we do break 50, the 50-day moving average, and that sort of 61.8 retrace at 65.49, then we've got 65.50, and then that recent high around, where are we? 67.07. Okay, moving on from that then to this week's main data points, all really inflation data and a bit of PMIs as well. We get to actually, yeah, let's look at the PMIs first of all. Nice matrix this from Reuters that you can see here. Just as I said, the blue line's expansionary territory above 50, those figures, and then the red line's in contractionary territory below 50. Mainly markets look at the Eurozone and the UK data. Manufacturing in the Eurozone, that's seen ticking higher, but still below 50 to 49.9. Services expected at 51.1, so pretty much close to the 51.3 previously, and then the composite, which is what we have here, expected at 51.0 from 51.2, so still in contractionary territory. Mixed data really from Germany for your guide. We had an uptick in the ZEW business data, but then the Centix, well, that lifted more than expected, but remained in the negative territory. The nowcast, just for your guide, in Germany, that points to quarterly growth rate of 0.4%. But then the Bundesbank update in Germany, that pointed to barely any growth in Q3. And especially we note, of course, that DIA data, the DIA industrial data for August in Germany that got released, I think, last week. France, that being focus, of course, as well, due to the recent political turmoil, although obviously we've seen some slight stabilization in that recently, and that probably won't be accounted for in the data set. Just remember that. For the ECB, PMI is unlikely really to move or have much of an impact on near-term policy, with markets pricing in a small amount of easing by year end, around 4 basis points, I think. So always just a sort of forward indicator, these bits of PMI data. As for the UK flash PMI expectations, services to hold steady at 50.8. They declined quite dramatically last time around from 54.2. Manufacturing expected to slip again from 47.0 to 46.2. That leaves a composite very precarious, actually expected a 50.1 versus 53.5 previously. So just watch that, and there could be some major headlines around the UK composite PMI if it drops below 50, of course. The issue really is around the autumn budget. Corporate clients, really, I think the note last time around said they were deferring spending decisions until after the November budget, and households also were hesitant around major purchases. Yeah, of course, this PMI data precedes then is before then the inflation data on Wednesday. Yeah, maybe look through slightly, although that composite figure will be interesting and grab probably a lot of headlines. Just moving on then to the CPI data. If we just look at UK CPI data first up, just a chart with the headline, the red, then the grey is the core CPI, and then services is the yellowy orange line. Expectations for headline are for the data to increase, for all the headline to 4% now from 3.8. That would match actually the MPC forecast, but would signify its highest reading since January 2024. That's mainly due to, well, motor fuel and airline base effects. For your guide. Previously, the headline held steady actually, while the call slipped previously to 3.6 from 3.8, and services slid to 4.7 from 5%. Key services, though, economists expect that to pick up to 5% this time around. But there are questions then, well, how long will we linger around this 4% mark? Probably well into next year, most economists think, although then this is probably around the peak level for headline CPI. That is double, remember, the Bank of England's 2% target. All in all, kind of from a policy perspective, then uptick, as I say, double the targeted level, and the uncertainty posed around the November 26th budget, that is, means, very little chance of a 25 basis point rate cut by the MPC. Of course, a little bit of softening in the labour market that we just talked about. Aside from that, then the odds of a December rate cut actually are fairly slim as well. I'm just checking what they are actually. They've moved up actually towards sort of 50-50 versus 25% at the start of last week, just for your guide. Obviously, the budget will be in focus with the fiscal hole widening because of surging debt payments. CPI report then that could fuel rate cut bets slightly if the data is softer than expected. That would then give Chancellor Reeve some relief if, of course, the annualized print comes in below the Bank of England's 4% forecast. Flip side, though, a higher than expected increase in CPI data that could see the BOE more cautious, of course, and then make the UK's finances look more precarious, really. A lot of eyes on this data, the CPI data. Gilt markets will be looking at it after really showing a little bit of optimism last week, really, with UK borrowing costs falling actually to over 2-month lows last week. And as I say, rate cut bets further out, picking up actually. So by February, sort of around an 80% chance of a rate cut. Due to those falling gilt markets from last week. If we look at cable then briefly, so sterling against the dollar, of course. Yeah, we've just got tracking sideways, really, just below the 50-day moving average at 134.72, that blue line, and then the grey line is the 100-day moving average at 134.85. Tracking sideways for the minute, waiting for this data. You'd like to think we've got the swing low from last week at 132.48, and then a major fib level at 131.40. We do break to the upside on probably stronger data, although watch that with conflicting signs for the budget. Then you've got levels at 135.27, and then that spike high from the middle of September at 137.26. Otherwise, then let's move on to US CPI data. Of course, we get this because the BLS, basically the Bureau of Labor Statistics in the US, has recalled staff to finalize this September data, essential that it is for calculating next year's Social Security payments. That's why they've asked the staff to come in. The White House Office of Management and Budget basically directed the move, aiming for publication on Friday, as I said. The original date was October 15, and that does then mean that Fed officials will see this report, of course, ahead of its meeting next week on Wednesday, the 29th. Consensus, this is the DXY chart, actually, just for you to guide quickly. Consensus, though, for the CPI numbers, headline expected 0.3% from 0.4% previously, and then the core expected to remain at 0.3% month on month as well. Softer, essentially, it's all about softer housing inflation, which is then expected to offset any tariff-driven delayed price pressures that we haven't seen as yet, but are potentially going to trickle through because companies have been taking on the tariff increases, but that will then seep through to CPI in the months ahead. Weaker labour and housing markets, yeah, they are seen as reducing inflation risks, though, and that then does support expectations of further Fed policy easing. The latest FOMC minutes actually revealed that officials are split over monetary policy due to differing views on inflation and the labour market. Most see employment weakening, which of course justifies further rate cuts, but then some have noted inflation risks. And still, officials generally see the inflation impact diminishing, expecting a return to 2% further out, but it's just in the near term, obviously, with this impact from tariffs. Obviously, as well, the government's shutdown that has limited our economic data. The economic data releases adds, of course, to uncertainty, really contributes to this sort of cautious, generally easing rate cut stance as well. Money markets, they price in around just above 50 basis points in total of easing by the end of this year. That does, of course, then signal two fully discounted 25 basis point cuts in the October meeting next week, and then in the mid-December meeting, those being the two FOMC meetings remaining for this year. The DXY chart then, of course, I always say this, but the biggest weighting in this dollar index is the euro by far, 56%. Then it's the yen around 14%, 1.4, and then sterling has around a 12% weighting. So just remember that, because if you flip this chart on its head, it's basically euro dollar. Which I'll show you shortly, which we didn't get to actually when looking at PMIs. But just quickly, so we've got resistance around 99.57. That's a long-term swing low from back in 2023. You can see there still holds pretty well, so that's why I've kept it on here. Otherwise, there is a fib level at 99.51 as well, a minor fib level of this move lower from those highs. Well, year-to-date highs actually and year-to-date lows pretty much at 96.21. That low is. If we do move lower, you've got the 50-day moving average just below as support, 98.03, and then the 100-day at 98.11. If we do lose those, then we're probably down to sort of below 98, 97, 60 region. And as I say, that long-time low, that multi-year low is at 96.21. That is the dollar chart and US CPI. Otherwise, as well, we do have, I said I'd look at euro dollar, so let me just do that quickly. We've got the 50-day moving average above at 116.92. Then we've got minor fill level of this move higher at 117.17. And then we've got a long time high at 119.18. Otherwise, if we do lose sort of the 100-day and that's halfway point of this move higher, that's at 116.55. If we do lose that, or the 100-day moving average of 116.50, then the next level would be just below 116, the 61.8 retrace of this move higher. That's a 115.92. Okay, otherwise, quickly, let's look at Japanese CPI data as well. This is the dollar yen chart. That's out on Friday. September headline, I think, is expected around 2.9% from 2.7, and the core around 3%, maybe just above from 2.7. Tokyo CPI, that's seen as a precursor really to this nationwide data. That eased actually to 2.5 from 2.6, while the core missed expectations remained at 2.5%. The recent moderation in inflation really largely down to government subsidies for energy and social welfare programs. A sustained rise in core readings, of course, that could tilt market pricing towards a rate hike this year, even next week. Odds of that happening at the moment around 1 in 4, around 23% odds of a 25 basis point hike next week at the Bank of Japan meeting. Otherwise, around a coin toss, just below a coin toss, 50-50 bet on a 25 basis point hike by year end. But obviously those odds have changed or will change with Takaichi coming in as well. For dollar yen, you can see the move higher after Takaichi won the LDP vote, of course, and we're just moving higher again on her coalition prospects, really improving dramatically over the weekend, as I said, with Ishin. So just watch that. The yen weakened substantially on her election, on her victory win. That means, of course, dollar yen went higher. And just pulling this back, we obviously have resistance and around those highs from a couple of weeks ago, actually at 153.27, 153.23. So that is decent resistance, you would think. Otherwise, we've got some fib levels in here, 151.61. And then the support level around the halfway point of this move lower of 149.37. Okay, I am going to wrap it up there. Actually, I should have said if you do have any questions, please you should have asked them along the way. Apologies, but I know you probably know that by now, most of you. So really do appreciate you being on the call. Just yeah, above 30 minutes or so. So a lot to look out for this week. Really, a lot, lots of CPI data, of course, but then of course all these other factors going on with the tariffs, of course, trade war, and just headlines around Trump and obviously China. And then we do have that situation and the vote in Japan, of course, this week. And then not forgetting earnings with Netflix out on Tuesday, Tesla out on Wednesday. That is after the US stock market closes. We'll be reviewing those next week, no doubt. And then looking forward to a huge week next week, I should say, with, of course, the Bank of Canada meeting actually ahead of the Fed meeting next Wednesday. And then next Thursday, we have the Bank of Japan meeting and the ECB meeting as well. And we have earnings from, and I'm just checking the calendar, Microsoft, Meta, and Google, so Alphabet, they are out on the 29th after the US close. And then we have Apple and Amazon, I believe, on the 30th after the US close as well. So a lot to review, preview. Preview next week, of course. We'll preview all those events as best we can. And then also review all of the events that we talked about this week. Okay, I'll wrap it up there. Thank you so much again for sticking around, and we will speak to you same time next week. Take care.